Hi, this is Fed Razak, Senior Trading Strategist here at CMTrading, and welcome to Technical Tuesdays. So today we're going to be discussing market lengths, but before we start, make sure to like and subscribe so you can get future content just like this. So what is market length and how does it affect our trading? So market lengths or timing is probably one of the most important factors when you're discussing technical trading. Not only is it cyclical, not only is it relevant for in and exit strategies, it's relevant for almost everything. It's probably the basis of everything that you can consider when you're trading the financial markets. Now, there's a lot of technicalities when you're going into market lengths and you're going into time framing, but let's go over some of the basics, okay? So number one, you want to know where points are in up and down cycles and where the points are between where you go from one low to the next low. That time interval is so important. If it's 3 months, if it's 4 months, you want to gauge for yourself, and then you could backtrack 4 months before or 3 months before, depending on what that time frame was and is. The next thing you can consider is a 3-day cycle. Usually if the markets sell off, they go through 3 or 4 days of either a massive sell-off or a massive gain, and then there's a correctional move that comes that 4th or 5th day of trading. That's another popular one. Another popular one is the January barometer. Usually what happens in January is currently the theme for that rest of the year. And that has been something that has been tested in time. Now, these are little tidbits. They don't always follow through, but many a time, if you do carry on and keep an interval consciousness, you will see markets repeat themselves because the markets are traded by humans. There's times of the year, there's autumn, there's spring, there's summer. Everything is considered to time. And we are basically confined to time, whether it's cyclical because of seasons, whether it's cyclical because of days. We're always committed and subservient to time. That's just the way it is. So time intervals plays a very important role when you're trading the financial markets. These are just examples of them. There are many of them. They're just like there's many technical factors, just like in candlesticks, there's many formations that you could ascribe. Also, when it comes to time frame, it's also very key as picking that points of entry and exit based on those time frames to give yourself that extra edge. It's not just, oh, did I get at the right price? It's also, did I get at the right time? Because even if you don't get the most perfect price, but if you're right on the time, you can make a lot of successful trades just like that. That's a very important concept. And if you think about it, it's striking while the iron is hot. That's all it is. It's being at the right place at the right time, even if you didn't get the right fill, even if you didn't get the right price. And that's really a very important factor. So we'll see you here next week on Technical Tuesdays. God bless you, everyone.